Ashish Gupta joins us, CIO with Axis Mutual Fund. When he went home yesterday, things were different. When he's come to office this morning, the world is looking different. Markets have not changed at all. So what would you say to the market reaction today? We are talking about geopolitical tensions from a market standpoint spiraling up. But the reaction in the market is a matured one. Why is that? Why is that there's no nervousness? Because war and military action means nervousness.
Hi, morning, Nikhil. I think you are right. There is a sense of higher uncertainty, but I think if you look even at the government statement that came out, it clearly said that it was a non-escalatory move, right? And I think you have spoken about it in the morning that there was already a sense of uncertainty that was building up in the market. The market was not reacting to some of the positive macro cues that had been there over the past few days. Even if you look at the earnings season so far, while the expectations were muted, thankfully the earnings season so far had not really disappointed on those muted expectations. So we have not seen a really major negative reaction to earnings. So in that backdrop, I think, and again, I don't want to call out or really focus on short-term moves in the market. But I think what we are really focusing on is what is the magnitude of macro stability that we have. And on that front, whether you look on the currency front, we are very stable. Interest rates, we have actually seen a very sharp pullback in yields ever since the beginning of this calendar year, because RBI has been comfortable with inflation and has really taken the system from a liquidity deficit to a liquidity surplus. And the recent messaging has been that they are likely to continue with open market operations. So I think even on interest rates, we are more comfortable. The fiscal deficit is looking good. You would have seen the GST number come out, and additionally, the low oil prices is also helping government collect higher excise. So I think the macro is stable, and that is a comforting fact. I think the broader direction of the market for us over the medium to long term will depend on really the pace of corporate earnings growth, and that's what we are focusing on.
Okay. I go back to that point again, pardon me, but I just want to clear the air on this one. From a market standpoint, do you think what is happening on the geopolitical front, if there is no strike 2, strike 3, and this, if there is no escalation in 24 hours or 48 hours, can that be a forgotten story then?
So I think we have some sort of playbook to look back to, right? So you look back to 2016, 2019, and that's exactly how it had played out at that point in time as well. And actually, in both those episodes, the drawdown in the market had been a low single-digit number, right? So if there is kind of this is not a continuing situation like 2016, 2019, we move on from this. I don't think this is an area that market will worry about.
Okay. When Ashish Gupta is on air, and if you don't talk about banks, then we'll not do justice, right?
Yeah.
We've seen a divergence in banks this time. There is one side, ICICI Bank, great set of numbers. The other side is Kotak, they are struggling. I looked at SBI numbers, good. I look at Bank of Baroda numbers, I won't use the word terrible, but disappointing I think is the word. So for a sector where everything is going right, credit growth, liability side, even NPAs, why is there such a big divergence?
So I think the NPA side has generally been good across the board, whether it is public sector banks, private sector banks, except for some NBFCs that had relatively higher credit costs. The NPA side across the board has been good, and the only soft spot has been the microfinance side. I think on margins and growth, we have seen a big divergence. And actually, the margin outcomes have been very different for public versus private banks. And public sector banks have seen some bit of margin pullback. Private banks have been actually able to generally beat market expectations on margin this quarter. While from April, you will see private sector banks also seeing a repricing down of their loan books. The expectation is that the deposit rate cuts that they have undertaken, and particularly the savings deposit rate cut they have taken, which feeds into lower funding cost immediately, should mean that even in FY26, the pullback in margins for the private banks will be modest. So I think market is taking that comfort, but I agree with you broadly that there are no real challenges for the banking sector. Credit growth had weakened over the last 12 months, but the change in RBI stance actually makes me optimistic that by the second half of this year, you'll probably again start seeing a pickup in credit.
All right, so that's the day coming in on the banking space. Hi, Ashish. Good morning. This is Shrishti also joining in. But Ashish, we do note that defense as a theme you have been liking for quite some time now. But given the tensions that we are hearing and we are covering as well, do you believe it's once again time to look out for some of these defense counters? What's the current view looking like?
So, as we spoke about earlier with Nikunj, I think one should not really trade based on sentiment. Yes, definitely many of these companies, their outlook is good. Their order books are full and the revenue outlook is strong. I'm not sure with what's happened overnight, there is going to be a material change for many of them immediately. So I don't think people should react to this news and look at this sector. We saw similar reaction happen when many European countries started talking about increasing their defense spending, and defense stocks globally, including India, re-rated. But the fact is that very few defense companies in India either export to Europe or even have excess capacity to be able to export. So one has to be careful in terms of distinguishing the sentiment versus the facts. I think there are a few companies that will probably benefit from higher defense spending in India and globally. And there we see larger upside, but I would not kind of say that it's a broad brush approach that you should take towards the sector.
Okay. Ashish, so what is the biggest moving part this year for the market? Will it be interest rates? Will it be commodity? Will it be tariff? What is that biggest moving part, or in a sense, the anchoring around the market for volatility?
I think the dollar. So I think to some extent, the tariff impacts, US economic impact will also translate into the impact on the dollar. And I think that will be really a key determinant into what happens to foreign flows. We have seen, despite all the talk of tariff recession in the US, because dollar continued to weaken, we saw FI flows to emerging markets, including India, resuming. So I think this is going to be a critical variable to look at. If the dollar continues to weaken, I think that is certainly beneficial for the market. It's actually been quite interesting in the last 3 months, because typically when US rates go higher, dollar moves higher. But this time, even though despite tariff announcements, US bond yields moved up by about 50 basis points, the dollar had actually weakened. And therefore, we saw flows coming back to emerging markets, even as US yields were going up. So that typically does not happen. So I think the direction of dollar will be the key variable this year.
So minus banks, what else are you liking? I mean, what else you think could give double-digit returns from here for next 3 years on a CAGR basis?
So we are looking at the consumption space more constructively. We are seeing actually mixed signs in consumption. So there are pockets in consumption that have started to recover from the last 2-3 years of slowdown. So construction is a space that incrementally that we have become more constructive on. We also like the EMS space. I think the opportunity there for India to benefit from the US-China rift is becoming bigger and bigger. There are not many stocks, but I think that is a space that is evolving. Then there are, we continue to like pockets like travel, hospitality, hotels, and real estate.
Appreciate your time.
If you like this video, then like, share and subscribe to ET Now.